Let's take a look at Access Holdings PLC 2022 earnings. They released that just hours ago, late yesterday. Total assets crossing practically 15 trillion naira, 27% year-on-year growth. Gross earnings, I'm going to ask my guest about this. I don't know why I'm too excited about this. 1.3 trillion. I think they are the first financial services company to cross that mark in Nigeria. 42% growth there. Net interest income, 19% growth, but then profit after tax down 5%. Profit before tax down 5%. Profit after tax down 4%. 167 billion, 152 year on year. Muyiwa Oni is with us. He is the regional head, West Africa, Bank Group Securities. Muyiwa, you're very welcome. Good morning to you.
Thank you for having me.
Thanks for joining us. Great to have you. So, I guess what's your take on what we saw from Access Holdings?
So I'll say I was actually expecting worse, and the reason why I was expecting worse was because of the exposure to Ghana.
So Ghana.
So I remember early in the year, so I guess following the challenges in Ghana and the debt restructuring last year, conversations around that, we published an outlook earlier this year, just looking at the exposures of the Nigerian banks to Ghana. And because historically, Ghana has been extremely profitable, very high ROEs, very high names as well. So they're typically ROEs, return on equity, and so your profit over your shareholders' funds. And the net interest margins are more or less almost like your spread between your interest income and your interest expenses.
Fantastic, thank you.
And so there, the market typically would have 15 to 20% versus Nigeria, where net interest margins would be in the 7-8% level, and that's typically seen as high. Yeah, so extremely juicy.
Yeah.
ROE over 20%, and contribution to profit for a number of the banks was high as well at group level.
Yeah.
So for Access, for example, as a 9 months contribution from Ghana to group profit was around 22%.
Oh wow.
About 20. I think for GT Co was around 18%. And so I think there was that concern that even if you don't see material impairments going forward with lower expectations that yields will be lower in that market, earnings outlook outside Nigeria won't be as exciting as it used to be. And I guess there was that concern as well, because there was an the delays in release of results was much more protracted than in the past. Historically, by March, most banks would have published their full year earnings. Some start in February, but this year we were still having banks that haven't released in April. So I thought, and historically as well, the longer your numbers are with the central bank, it means there's some long debate and negotiations around different lines. So we thought that would mean numbers would come in far more lower than expected. So at about 4% decline in earnings, that wasn't as negative as we would have thought. I think maybe the bigger point was the dividend payment. We also thought across the bank, because of that earnings pressure in Ghana, dividend payments will be lower, because clearly they won't be able to pay a dividend from the Ghana subsidiary.
But they still give a help.
50%, 50% higher than the previous year and higher than our own expectations as well. So with that dividend yield of almost 17%, 16.7, which I would say across our coverage seems to be the highest, so far. So that's been, I'll say that's clearly positive for the market, for investors, even though there's still that concern of what happens with Ghana. I think there's also the concern of sustainability of some of the earnings lines, particularly trading income. That's for some time now, particularly since we've been having these FX challenges, you've seen derivative gains, trading gains, being a significant contribution of non-interest revenues. So for Access is about over 50%.
Oh, wow.
For most banks, trading gains typically will be maybe about 15 to 20%. Fee income will be a dominant part of your non-interest revenue.
Wow.
So I think that since 2015, the number seems to have been much higher, and I guess we've been wondering at one point, will this unwind? Will this unwind, or will this still be a key driver of earnings going forward?
The Ghana impairments, you mentioned that 100 billion is. Are we past that now? Is this a one-off? Because I wanted to also. I think we'll go through the other banks if you want to talk about this impairment now. So. one-off, we put that behind us, and if not for this, because if your profit after tax is 152 billion or so, you're losing 100 billion, then definitely this had an impact, yeah?
Sure, yeah, it did. So I guess if you add this back, for example, you're talking about
200 and something billion in your profit, yeah.
Yes, and so I guess with the material size, one could argue that maybe it's getting past, but also I think if we look at the ratio, so they presented fair value of their government securities to Ghana. I think that was over 300 billion.
Yeah, 348, yeah.
And a ratio, so if you look at the ratio of the impairments taken, even though I'm not sure if that figure is net of impairments or pre-impairment. So if it's net of impairment, you'd say it's about 30% provisioning. If it's post impairments, there may be 20% levels. And so with that, one can argue that it's still one of the more prudent within our coverage. I think GT Co was over 20% as well, because what they did as well was to take provisions on the whole exposure to Ghana sovereign, both domestic and Eurobonds. That's what Access have done.
Yeah.
GT seems to have done that, ETI as well. Zenith seems to have just focused on the domestic bonds that are currently being restructured. But I think their overall government securities book is in stage 2, so there's still some provisions have been taken, but not as...
Wait, so does that mean, if we look at, so Zenith could be, there could be more down the line?
There could be more, particularly on the Eurobond side.
You know what? Because I was reading the financials for Access, and they did mention something about domestic debt versus the EU. So, so that means that these figures we could still see more of impairment.
Yes, and I guess because we've spoken to a few banks, and I guess if one thinks that these negotiations take some time as well.
Yeah.
So Ghana is Zambia, for example, is still ongoing after a couple of years.
Yeah.
And so with Ghana, it could be protracted, and if banks are having to take provisions, you could get to a point where they would have to inject capital into that business. So some of the banks we've spoken to seem to be more conservative and think they're not out of the woods yet, and we could still see some pressure. Others feel maybe they've been prudent enough. But if you compare with the South African banks, for example, they seem to have taken close to 50% impairments on their exposure, which if you think of where we are, you could say there could be more to come. Because I guess the benefit of that is if things turn out better, then could be an upside, a clawback on that. But if you are not as conservative, then you could have to take some more pain.
So look, the takeaway from all this, the Ghana is an important metric for the financial, for a number of financial services firms across well, I guess maybe sub-Saharan Africa, I guess. So
yeah, I guess yes, and because of the high yields, there was almost a no-brainer.
Yeah.
So I remember when I initiated on the Ghanaian banks in 2015.
Yeah.
Then there was always that question, particularly coming from Nigeria, where NIMs and asset yields were much lower.
Right.
And you're seeing double-digit NIMs.
So you're rushing to Ghana to
and you're thinking, how long will this go on for as well?
Yeah.
And I guess that's always been the question, how strong is this economy growing to be able to afford this high interest rate environment? And I guess on the sovereign side, you've seen the sovereign break. There are questions on the corporates as well. So a number of banks are also quite cautious with overall exposure to Ghana, even on the corporate side, because it's difficult to assume the sovereign will be under pressure and then corporates will be fine.
Exactly.
Yeah, so I guess there's that bigger concern of the country as a whole, and for some, just caution around exposure to Africa.
Yeah.
Because I think for the past, well over a year now, almost 2 years, the IMF has been talking about their challenges and so on. So I guess that's been a theme going into the year as well, that I guess this clearly means some pain will come, but I think it also changes how banks look at regional exposure, regional expansion as well.
You think this changes things? Will the banks, look at their footprint across, at least for the Pan-African banks, look at their footprint across and maybe retreats with the...
So I guess, we posed a question to one of the banks. They didn't think they would retreat, but the point was they will be way more cautious with any further expansion plans. They're just trying to look at risk in a much more holistic manner. And I guess the challenge as well is, as a bank, lending to the sovereign is your safest bet. So it's low risk, it qualifies as liquidity ratio. So in a way, for a bank that has high exposure to government securities, it's not reckless. but you are currently being punished for
I
that. And so when you have investors talking about banks' exposure to sovereigns, and as a local bank, you have to be exposed to your sovereign.
Yeah.
Because because sovereign can print money at the minimum, if you think about it,
And
unlike
bail things
corporates
out.
that can't
Right,
create.
right.
Yeah, there's a limit to how much value they can create per se. And so I guess it just changes how you think about banking in this environment as well.
Yeah. Okay, speaking of which, let me take you up on that. Banking in this environment, for folks who are watching, the financial services sector is the most active sector on the NGX. What you have stock picks? How do you see all this falling out as far as the banks are concerned? Are you still bullish or bearish or in between with respect to the stocks on the NGX?
I think from the valuation perspective, bullish. And the reason why is if you look at the banks relative to the other sectors, price performance has been weaker. And I think particularly for the larger banks. So the likes of GTCO, Zenith, and even UBA Access to some point have not, the share price performance over the past 12 months has been lackluster or weak.
Right.
And for Zenith GT, more because over the past 2 to 3 years, foreign portfolio investors they've still been strong holders of this stock, and they've been selling out, leaving Nigeria because of the challenges we've had. And I think there's some level of optimism that with the new government, if we start seeing more business-friendly policies, and if there is some form of reforms in the FX market that will bring back liquidity, you could start seeing these interests come back, and those are the banks investors will come to first, just GT in particular because of its higher level of governance and so on, and strong efficiency and profitability as well. So those two I'd rank as top. So GT number one, then Zenith in terms of that order. And then UBA as well. Access, we have a speculative buy, and it's really more because of some of those non-interest revenues. There's questions around sustainability of those lines, particularly the trading and derivative gains. And we think it's difficult to sustainably grow those revenue lines, particularly if the economy normalizes and you don't see the kind of volatility or concerns in the FX market like we've had in the past.
So FX still, as far as the economy is concerned, that's still a big issue with returns.
It is. Particularly, so if you talk to the corporates, so the FDI investors, foreign direct investors, talk to the foreign portfolio investors as well, it's FX. And it's FX for the corporates because you still have a reasonable amount of imports that are, or a reasonable amount of your inputs that are imported, and you need FX to buy those. And so production becomes far more challenging if you're not able to source FX. And for the foreign portfolio investors, you need to be able to, you need that confidence
and transparency.
That you can always go in and out of the market.
Right.
And I think that's what's kept investors out for some time now.
Yeah, just a minute ago, as far as the health of the banking sector, like the MPC now, the continued hike in rates, I mean, obviously they've enjoyed that because of their net interest margins. How do you see the banking sector, I guess, playing out for the rest of this year?
So I think with higher yields, it's clearly more positive, and more so because for most of the banks, you have a reasonable amount of their assets not yielding any interest because of the high cash reserve ratio environment. And then you also have some special bills that are earning just 0.5%. And so for most banks, you have at the minimum 35% of your deposits sterilized. You have maybe 20% of your assets not earning anything at all. And so there's the benefits that one has seen from higher interest rates seem to be driving up higher yields on assets. But if banks at some point are able to unlock those sterilized deposits, then the outlook on yields would even be way more as well.
Fantastic stuff. Muyiwa Oni, Regional Head, West Africa, Bank Group Securities. Thank you so much for giving us the lowdown on the banking sector, Nigeria, Africa, and Ghana. Still very important. I appreciate your time, Muyiwa.
Thank you for having me.